If you don't understand what a pip is, you cannot measure profit or loss in Forex. A pip is the smallest movement in price in a currency pair. For example, if USD moves from 1.1010 to 1.1011, that is 1 pip. If it moves from 1.1010 to 1.1015, that is 5 pips. A pip is usually the last decimal place of price codes. Most pairs go out to 4 decimal places, but there are some exceptions like the Japanese yen pairs. They go out to 2 decimal places. Example is the USD. It is 0.0001, and for the USD JPY, it is 0.01. Traders use pips to measure how much they gain or lose in a trade. For example, if you make 20 pips, that means the price moved 20 units in a direction. If you lose 10 pips, it means the market moved against you. Understanding pips is important because every trade you take is measured in pips. Before you can manage risks or calculate profit, you must understand pips. In the next video, I will explain lot size and how it affects how much money you make or lose. Follow to learn Forex step by step.